Good morning, everybody. Hey, welcome to Thursday morning, March 4th. I hope that you're doing well as we get ready to look at what's happening in the marketplace. Yesterday, we'll talk about that in just a little bit, but it was kind of a down day. Let's just kind of show the initial numbers there um, for the yesterday. So Dave and I will talk a little bit more about that, maybe what's causing some of that as we prepare for today and moving into this finishing up this first week of March. But again, I want to thank you for joining us today. Remember, folks, there's only one thing that anybody can control in their portfolio, and that's how much risk they have. That's the only thing you can control is the risk that you have. And so it's hard to do that if you don't know, number one, what your risk number is, and number two, how much risk do you actually have in your portfolio? Statler Financial, that's really and truly what we do is help people analyze the amount of risk they have in their current portfolio. If your advisor's not doing that for you, you need to give us a call at 863-382-0037. That's 863-382-0037. Hey, Dave's coming up next. Looking forward to our conversation with him. Hold tight.
Fam, Uncle Crack. Morning, Dave here. We're at 8:40, 20 before 9. Time to check in and see what's going on Wall Street this morning, see how your IRA and 401k are treating you. Let's check in with the resources of Statler Financial Services in downtown Sebring. Phillip Statler is standing by. Phillip, good morning. How are you?
Good morning, Dave. Hey, doing well today as we're getting close to winding up this first week of March.
Yeah, I still can't get over the notion that we're already into March. Setting the table, it was another off day yesterday on Wall Street. NASDAQ was down by 2.7% again. Dow was off by about 1/3%, and the Standard & Poor's was off by 1.3%. So it was a decidedly down day. I had kind of an interesting piece. We were talking about it before we went on the air. One of the analysts that I was reading a think piece on said, don't worry about NASDAQ. It's not a bubble, but what we're doing now is after the techs were expected to do well while we were staying at home an awful lot more last year because they're the convenience electronic stuff. Now that we're starting to get out of the house a bit more, all that's really happening is the money is being reallocated to other sectors. Like the financials and industrials are doing generally better than the rest. They're up, contrasting to the techs that are off. That sounded like it made a little bit of sense to you as well while we were kicking it around.
It did, because I noticed our analysts that we use, we made some portfolio changes this week, and we did move out of some tech names, and we did go into some of the financial names. So that does make some sense to me. That very well could be what we're seeing, though nobody wants to shed tech totally because we never know when it's going to come rearing back.
Well, yeah, we have a tendency in this world, and it's not necessarily always a bad thing to chase the next shiny new thing, and that next shiny new thing is probably going to be somewhere in the tech sector, so getting out of it probably is as unwise as staying over-invested in it, I'd imagine.
Well, that's true. Yeah, it's all in allocations, and how much do we have allocated to tech, to financials, to consumer goods, all those things. That's what the analysts get. That's why they get paid, is because they're the ones that analyze all that stuff and determine what the allocations need to be.
Understood. It also kind of addresses the gospel that you've been preaching for a long time about being diversified and watching your risk factor. Being overinvested in one sector is never a good idea for a person getting anywhere close to retirement.
Yeah, Dave, I got to tell you, every now and then I'll sit down with somebody that has company stock, and it's the majority, if not astronomically, the majority of what they own, and that just scares the bejeebers out of me.
Oh yeah, it's any time you overdo any sector, whether it's your own company's stock or not, you can get in deep doo-doo. We start the morning out with a whole bunch of data dump out of the federal government. Start out with the good news, and then we'll get to the news we expected. Productivity in the fourth quarter, when we first got that reading, it was 4.8% down from prior measurements. They revised it. It was still off, but they revised it upward to 4.2% down, so at the very least it's heading in the right direction. Then we get to the unemployment numbers, and everything pretty well as boring came in about what we expected this week, didn't it?
It did. The first-time claims actually are just a tad bit better than expected. We saw a reduction in continuous claims. We did see the unit labor cost revision come in, and it was off a little bit, that at 6% versus 6.6% that was expected. Later this morning, we'll get factory orders. I think that'll be an important number to really gauge what's happening from the economic standpoint.
Understood. Other indications that we're going in the right direction. This is not an official government figure, but MasterCard put out a press release this morning saying that they saw February retail sales up by 4.6%. Now, MasterCard is just one supplier and one reading, but boy, if the other major suppliers show the same kind of increases in February, we are actually turning a corner a little bit, aren't we?
It very well could be. I mean, that would be great news, right? And then think about what March could look like, Dave, because what do we see? We saw Texas and Mississippi saying basically there's no more bans on anything. Open up all the businesses, open up everything. And so that could be a boom for retail sales.
Absolutely. A couple, three more states opening up, just kind of like an automatic. We are still doing earnings season, and you got some pretty substantial retail numbers to report this morning, don't you?
We do, Dave. It's we had some yesterday. We got a few more today. As we look, we have the likes of BJ Wholesales. I think you got to go to Orlando or Tampa to find one of those close to us anymore. But they beat by 3 cents a share. Revenue top forecast as well. And so their same store sales, not including fuel, because fuel is fluctuates in price so much, but they beat by 0.4%, better than expected. They're up 15.9%, same store sales over last year, so that was good. They did decline to provide any guidance for 2021, which that sometimes is not good. The traders, they want some certainty and they want to know what you think. And so they're trading down this morning 3.1%.
Even a wild guess beats no guessing, right?
At least at this point, it sure seems that way, Dave.
Looks like it. Yeah.
The other one we have is Burlington Coat Factory. I guess it's not called Burlington Coat Factory anymore. It's called Burlington Stores officially now. They beat by 32 cents a share. Revenue also above forecast. I guess that means people are getting back out there and buying stuff, like MasterCard said. But they do see same store sales were flat, which was really good because they expected them to be down 10% year over year. And
cool.
So they are, man, Dave, they should be on one of your big winner lists today because they're up 9.2%. They'll open at a new 52-week high right now at $276.
All right. That's good. Retail overall is good news. I don't know, does Burlington do a lot of internet business, or are they all brick and mortar with their outlets?
There's no indication of digital sales anywhere in here. So I'm thinking it's a lot of brick and mortar.
Yeah, I recall them up in, we had a lot of them up in the North Carolina corridor when I lived there. I remembered them as being just a great big warehouse. Didn't lend itself well to the way I'd envisioned the internet sales boom to be going, even though I haven't seen one since the internet boom hit. Kind of curious whether or not they were actually doing it off of the brick or mortar stores.
Yeah, I haven't seen. But the last retailer I have for you is American Eagle. They beat by 3 cents a share at 39 cents a share. Revenue came in just a little bit above what Wall Street had forecasted. And they're forecasting it says here, the best first quarter sales in 3 years.
Boy, how long have we heard that kind of superlative, huh?
That's pretty good. They say they've come up, I guess, with a new line of loungewear and lingerie brand called Aerie, as AERIE. I don't know how you pronounce that, but so they're getting a pretty good boost today, up 6% this morning.
Crud.
Yeah.
I'm having trouble resisting trying to imagine American Eagle lingerie. It's made of flannel, isn't it?
Yeah, I don't think so, buddy.
Just some brands just I don't think about for that particular category. Resetting the table, it was an off day on Wall Street yesterday. 45 minutes before we open this morning, I'm seeing an improvement on my delayed quotes. Have we made it into green ink yet?
You know, Dave, we have been all over the place. We were down substantially when I woke up this morning and started following it. We were green when I got here to the office, and now we got a mixed bag. We got the Dow up $29, which is basically a tenth of a percent or a little less. We got the S&P 500 down less than a tenth of a percent, $2. We got the tech NASDAQ down less than a tenth of a percent at about $12. So it's looking like maybe we could have a decent open as we get closer and closer to 9:30. On the commodity side, though, we see at least in gold and silver getting hit pretty hard. Silver's down another 1.1%. Gold's down 0.2% to $1,712. Crude oil kicking back up to 1.5% to $62.22 a barrel right now, Dave.
Well, poop. I don't know what caused that. I don't think there was an inventory number yesterday. Overseas markets, maybe our futures were herky-jerky because of the Asian rim. Those markets were down 2+% this morning early on. Europe's being a little circumspect about it. We're off, but by like 2 to 3/10 of a point, and that's about it over in Europe halfway through their day. Phillip, we were talking about different categories and different investment strategies. That takes a little bit of neutral eyesight in order to help advise a client. How do I get a hold of you in order to stabilize my investments?
Then give us a call at 863-382-0037. A great opportunity to really and truly dive in and see how much risk you have in your portfolio and to make sure it matches up with your risk tolerance number. Go to our website, statlerfinancial.com, and then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk 730.
Good stuff every weekend. And tomorrow we get to pick apart the national unemployment rate, which means nothing but sure does affect the news, doesn't it?
It does, and it affects the marketplace.
Yeah, big time. We'll find out then. Thank you, sir. We'll see you tomorrow.
All right, have a great day.
Take care. It's 105.7 Light FM and Statler Financial Services, Phillip Statler.
Hey, folks, again, I want to thank you for joining us today. I hope that you're finishing the week off great. I look forward to talking to you again tomorrow. Stay tuned. See you then. Bye now.